You know, retirement's something we've been hearing a lot about, and it's not in a good context. People are scared. They're worried that they're not saving enough, they're worried they're gonna run out, and they're worried about what the markets are doing and what they're gonna do in the future. So today, I'm with Christy Van. We're gonna talk about a better retirement. We're gonna talk about creating a volatility buffer, a bridge, if you will, over the rough parts so that your income that you're taking when you're retired doesn't have to be relying on all things working the way they're supposed to with the markets. It's all gonna be in your control. And then what we're gonna do is we're gonna show you how your retirement is also gonna be what's gonna fund buying cars. Yes, buying cars. And those car buying experiences you're gonna go in are gonna help fund future retirement income. And not only that, one of the things that's going to happen for everybody that retires is they're gonna need a car. They're gonna need probably multiple cars during retirement. So why not finance all your cars so that you get all the money back, and so that all the money that's coming back is helping you earn a higher income in your retirement? Well, with that, let's dive in. Today I wanted to go somewhere different, not just go right into the infinite banking concept and how people can become their own bank and take back control of their money. I want to talk about something that's on most people's minds, and that is retirement and the uncertainty around retirement. And I've studied this extensively in my 22 years in the financial industry. Started as a financial advisor in 2003, went through many different cycles of that career, and then left the financial industry in 2018 to pursue our HGTV show that me and my wife did called Risky Builders. But what I want to talk about is the things that I used to know or think I knew about retirement planning, about investing money, to now, 22 years later, what I actually know to be fact. And to start this off, I just want to kind of come over here to this board, and we drew some pretty cool photo here. But really, human emotion is one of the most powerful things for anyone's investing, anyone doing investing or anyone planning for retirement. This is the thing that's either going to make or break you, and it goes in cycles. And I just want to break this down so your audience understands that. When we go through these different cycles, right now we're up here, we're in an overconfidence cycle. And I think that's starting to break with all the stuff going on in the world, wars and all different stuff. But people are starting to question whether or not the markets are going to keep delivering these amazing returns they have over the last decade, because this has been the longest bull run or the longest positive run in stock market history, to the point of, and I might get this wrong, anyone 37 years old or younger has never felt the impacts of a financial recession. They don't even know what that feels like. Now, I know myself, yourself, and a lot of your audience, we all know, because we went through the Great Recession. We went through the dot-com crash. So we know what that does to our finances. But this is why these different human emotions are so important to understand. And I'm just going to walk you through, when we're at the very bottom of the market, we'll call this 2008, people are in a state of disbelief. They can't even believe that the markets have gone down that much. They can't even believe they've lost that much money. But eventually you come out of a recessionary or that period, and you hit an uncertainty period where you're uncertain, but that leads to an optimistic period of time in that cycle where their optimism is rising. That goes to a period where they just think that everything is going well in a euphoric state, and then an overconfidence state. It's kind of like this bull and the bear, and you've always heard the story of the bull and the bear. The bull is always saying, look at that. It looks like an all-time high. Oh, look at that one, another all-time high. Oh, another all-time high. And the bear is just sitting there being like, what the heck? But let me just kind of come over here, because this is where we're going to go next. We're going to hit this phase, and I think we might actually be starting to see this, because I know I talk to a lot of people like you do, Christy, and people are starting to have concerns. The markets are ping-ponging, lots of volatility. If you turn any news channel on, you got all sorts of crazy stuff going on in the world. So people are really starting to get anxious. They're starting to have this uneasy feeling in the gut. And this is something people should not ignore, because when you start having that uneasy feeling, that gut feeling, as they would say, you need to listen to it. Because what has happened over a decade, the longest bull run in history, is not going to continue. It just can't. It never has in history. So why would this period be any different? But we'll enter a period of anxiety when the markets start going down, which we have seen markets going down. We'll hit a part where we hit denial, then panic, capitulation, and then right back to where we are: agony, depression, disbelief, uncertainty, and then we climb back up. So what I'm trying to say, and I know a lot of the people watching this may be like, what are we getting to? I'm showing you how to eliminate all of this, how not to have to worry about all of these cycles. But I'm trying to explain also that the stock market is driven by human emotion. It is single-handedly one of the most powerful things. And that human emotion can be summed up by fear and greed. That is it. Fear and greed. Now, I have worked with thousands of people, and I know you have as well, but I've worked with them to show them different pathways, alternatives to the fear and greed model, alternatives to riding these crazy cycles that really tear us apart inside, create a lot of stress, a lot of problems within our families. I mean, I usually don't get into this, but one of the number one causes of divorce is financial pressures, stress. And that's really sad, because it's really something we can avoid. It's something we can not participate in. Literally, you could just, that's like your TV. When you don't want to watch anymore, you just hit the off button. You could shut all of this off. And I would tell people that that's the easiest thing in the world to do. So let me come over here and I'll show you how it can be done. And it's way easier. This is the same chart. I went back to 1960 and just took it up through and just showed the different, as best I could, different ways the market works. But what if every single time you get that gut feeling, every single time you start getting uneasy, what if you just created a bridge? Think of the Grand Canyon, right? If any of you have ever been to the Grand Canyon, when you stand there, it's quite the spectacle. You sit there and you look at this ginormous canyon and you look over to the other side and you're like, wow, that's a long way. Now, if somebody was really optimistic and they wanted to cross the Grand Canyon, they could indeed be a lot of work, climb down that massive cliff, get to the bottom, swim across the river at the bottom, and then climb back up the other side and make it to the other side and say, see, I told you I could. Now, Christy, I don't think you'd want to do that. I certainly wouldn't. Because what we would do is we would just look down both sides and we try to find, there's a bridge around here somewhere. I know somebody built a bridge, and I think that's a way easier across this ginormous canyon. And we'd find the bridge, and we would just walk or drive our car across the bridge. That's what we're talking about. And that literally is how simple it is. Building the bridge over the problem, over the market fallout, that's what people need to do. Now, I'm going to give you an example here real quick, Christy, and then we're going to get into the infinite banking, because the infinite banking concept can be an incredibly powerful retirement tool, but not in the sense of how most people think of retirement. Because most people think of retirement in the form of IRAs, individual retirement accounts. They think of them in the form of 401ks, where your employer provides you a retirement. Maybe they give you a match. You put your money in there, and, at a magic time, after 59 and a half, you can take it out. But what if there was just a better way? And I'm going to show some slides here because I think this really sums it up. And I want everybody that's watching this to understand that this is a real client, a very long time ago, but we helped Chuck and Mary Jones. So here's some interesting things about Chuck and Mary Jones. And they gave us permission to use this. They were not good at the markets. Matter of fact, they didn't care at all about the markets. They had no clue what they were invested in. They had no clue why they were investing money. They just knew that they wanted to retire. So when we met with Chuck and Mary were 10 years away from retirement. Okay. So in their eyes, they had some time, but they needed to kind of get in a hurry. They had $350,000 combined between the two of them saved in retirement accounts. One was a 401k, the other was an IRA. They were completely inexperienced in managing investments. Clearly, as you can see from the photo, they like their horses. That was where they found, the comfort, and that is where they found having fun, was with their horses. And they did not at all want an active role in investing. Because when we asked them, how are you investing? What would you like to do? It was kind of just like, I don't know. What do you think? I don't know. They didn't want an active role. But here's what we got them to understand. We got them to understand that the path through what their goal was, and their goal was simple. We want to be able to retire. We want a fixed income coming in that's sufficient and more than what we're making now. And we don't want to run out of money. Now, the first thing I want you to look at here is I want you to put yourself into this. Okay. You're 10 years from retirement. You and your significant other have $350,000 in your retirement accounts. Are you panicking right now? I would hope so, because you're a long way away from being able to retire. Now, let's just put this into context the same way we did it with Chuck and Mary. If you had $1 million in retirement accounts, based on today's numbers that the financial advisors will use, the drawdown numbers, typically they would say you could draw 4% safely, okay? That's the safe number of withdrawal rate, okay? 4%. So just do the math. $1 million, okay? Taking 4% out, it's roughly $40,000 a year. How many of you can live on $40,000 a year? The answer is none of you. What if it was 6%? Could you live on $60,000 a year? So you can see what I'm trying to say. $1 million in today's world of retirement planning or income planning, you're screwed. They only had $350,000. But let me show you how, by being their own bank, they were able to not be concerned. They were able to get on the right side of this, and they didn't have to work harder, longer, or take on any additional risk to do that. What they basically did is they started right here, $350,000 a year. They were contributing $13,000. Now, this is old, like I said. They were maxing their IRA contributions out at that time. So it's more today, but just remember, this is many, many, many years ago. $13,000 was the most of that year that they could put into their IRAs. So what we did is we projected that forward for 10 years. They're going to continue to save into their IRAs of $13,000 per year. Now, you see the interest rate right there? 9%. That's not a hypothetical rate. It's not like you putting money in the stock market and someone saying, well, if this happens right and the sun comes up every day and there's no clouds and it never rains and it never snows and everything's perfect, you make 9%. Now, as you all know, you might make 20, then you might make -5, then you might make 2. The markets are all over the place. I showed you that a little bit ago. But how is it that they could make 9%? Well, what they did is they changed where their IRAs were held. They moved them into self-directed IRA custodians. Okay, it's just like where your money would be now, maybe Fidelity, Schwab, wherever your money is. It's the same thing, but they moved it to a custodian that allowed them to invest in alternatives like private lending. And that's exactly what they did. So from their self-directed IRAs, they basically lent their money out at a rate of 9%. And that 9% on the balance, okay, because they were, over this period of time, 10 years, they were able to accumulate $1,026,085 in retirement. Now, remember a second ago, I told you you'd have a really hard time retiring on $1 million at the normal withdrawal rate of 4%. But what if you could earn 9%, 10%, 11, 12, okay? And I'm not talking with one of the gurus' magic mutual funds. I'm talking about being your own bank. You easily could make 9%. Banks charge 9% every single day. And you could do it with secured first lien positions. Now, I'm not here to teach you how to do all this. I'm just making a point, and a point that should land really well, because let's do the math now. Let's say you had $1,026,085, just like Chuck and Mary Jones did. At 9%, lending their money out at 9%, they would have an income of $92,347. Okay? That means their monthly income is $7,695. Now, that's before Social Security, and that's before any pensions if you're so lucky to have one. They did not, but they did get Social Security. And here's the other thing. That income, that $7,695, did not touch their principal. So that $1 million, that $1,026,085 remained. They just earned interest on that money, and that's what provided their retirement. But the interest wasn't that of the markets going up, down, and sideways. It was just interest income coming in. Now, I'm going to stop sharing that because I want to take this into a completely different realm, okay? I want to show you something that I think is even more powerful, and that's back over here to the board. So I'm just going to create a new screen, and I want you to kind of see what I'm thinking about. If we started, and I'm just going to use their numbers, if that's okay, folks. Okay, if we started with our IRAs, because most people are going to have 401ks or IRAs, whether or not I think it's a good idea or not, it's irrelevant. Okay, they're going to have their IRA. Now, let's just say in this scenario, they had $1,026,085 in their IRAs. And that was generating for them 9%, and that 9% was $7,695. $695 a month. Okay, that's their current scenario. But most people are not going to put all their eggs in one basket like this. And I would advise that you need diversification. So most people are going to have whatever money here in their IRAs, but then they're going to have other money. We call it their 401k, which are all going to be stock-based. Maybe you got a portfolio of stocks and bonds. And that is definitely going to ride this roller coaster like this. So here's the thing I always tell people. There's a couple different ways you can plan for retirement and a couple different ways you can mitigate risk into retirement. And there's a lot of risk in retirement. A lot of people worry about running out of money. They worry about getting sick and having to use the retirement assets that are there to provide them an income to pay for healthcare needs or unknown medical needs. They worry about inflation. They worry about the markets like we all are right now. So all these worries impede on our retirement being a fun one. So there's this thing called a volatility buffer, okay? And all a volatility buffer does is if you were in, so we already know we got this, but again, there's very few of you that are watching, and if anyone needed help kind of doing that, we definitely can, but let's get to the most important thing. You're going to have some income coming in from fixed sources like that. Then you're going to have some income coming in from the markets. One of the worst possible things that could happen in this scenario is the markets fall. So let's just say you were taking your 4% from there, okay? And most people are going to take more for withdrawal rate. You were taking that. Would you want to take money out of your 401k when it's going down like this? Absolutely not. You would literally run out of money. No ifs, ands, or buts about it. If you were living on a market-based 401k or retirement savings and the market started falling and you're taking money out as it's going down, you're going to learn very quickly what the drawdown effect is. Now, what the drawdown effect is, I don't want to get too technical, but basically think of it this way. If the market's down, and I'm just going to make some numbers up, I'm not going to nail it. If the market's down 30% here, okay, so we've got a 30% drawdown on the market, and you take out $10,000 at 30% down, you're going to have to make back roughly 47%. Don't hold me to that number, but it's about that. You're going to have to make back 47% on the upswing just to get back the 30% that you lost because you have less money. So that's compounded by taking money out when the markets are going down. So the best way to do this is to create a side fund, okay? So how we always do this, and now I'm going to bring in the infinite banking concept. So let's just assume that today, while you're planning for retirement, you divert some of the money that normally would go to the 401k. So let me show you how this would work. You got a 401k. Let's just say your employer matches you 4%. I'm just going to keep this simple. And most matches are going to be 3 to 4%. But you're putting in 12, let's just say you're putting in 13% of your pay is going into the 401k. What we would typically tell people to do is let's stop putting this in. And we got to work with your CPA and make sure that, this is the right thing to do based on your tax needs. But we would bring you down to whatever your match is. Okay, so let's say then we just start contributing 4%. That's your new contribution into your 401k. Now, you're going to say, okay, well, I'm used to putting 13% in, and now I'm only putting 4%. So what am I going to do with the other 9% if I'm doing the math right? I think that's right, isn't it? 9% that you used to put into your 401k. We're going to divert that, and we're going to put that into, and I know this is going to sound crazy for some of you, a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Now, that sounds crazy. That now we're taking some of your income that used to go to your 401k and we're putting it into a life insurance policy. Yep, we are. But this is not a normal life insurance policy. It's designed and engineered for high early cash value. Literally, you could put money into this whole life and you'll have access to that cash value immediately in the first 30 days. You might not have access to all of it, okay, but 60 to 90% is very common that we would be able to take out. Now, here's what we're going to do. And I want to bring this back to the retirement. Now that you've got that income going into the whole life, we're not going to just leave it sit there, okay? The first thing, and Christy teaches this every single day, is we're going to take loans from the whole life. And we're going to take loans because when we take a loan, let's just say the whole life policy that you have, and this is going to vary. They go anywhere between 5.9 and 6.6. Well, let's just say the policy we put you in has a dividend crediting rate of 6%, which is very, very doable today. You're getting 6% on your money that goes into your whole life gross. Okay. Then when we take the money out, we're going to take it as a loan, and the insurance company is going to charge us, hypothetically, let's just say it's 5%. Now, right now we have carriers that are under 5% from the interest rate standpoint, and we have carriers that are over 6%. I'm just generalizing and giving you kind of a middle of the road for the dividend crediting rate and the loans. So real quick, and Christy, I always ask you this, but I know your answer. If you knew of a traditional bank that you could go to and you could deposit money and that bank paid you 6% on your money, but that same bank allowed you to borrow money at 5%, would you ever use your own money that was earning 6%, or would you borrow money at 5%?
I would borrow.
I think your entire audience and my audience would say the same thing. Because I'm earning 6% and I can borrow at 5%. Why would I take my money out that's earning 6% to borrow at 5%? Now there's some circumstances that maybe could change that, but let's just keep this simple. I think every one of you would agree, yes, I'd borrow at 5% if I was earning 6%. And you do that because you're making a 1% spread. You're doing what a bank does. You're earning a spread. And that's the reason we do that here with the whole life policies. By using the money from the whole life as a loan, you're doing the same thing. Because whatever monies you have in cash value inside the whole life, in this scenario, if it were earning 6%, hypothetically dividend crediting rate, when you take the loan out, you're not using your money. This loan is the insurance company, okay, that giant mutually owned insurance company. They're giving you a loan from their general account. And just so you all know, these insurance companies, these giant conglomerate insurance companies, some of these insurance companies have hundreds of billions of dollars in their general account. So if you had an insurance company, you had hundreds of billions of dollars, you would find the safest ways to make that money go to work for that insurance company. And one of those ways is allow your policyholders to borrow the money from the general account, because then they're making 5% on that money. But here's the cool part. And I'm just going to use simple money, simple math. If you had $10,000 in cash value and you took a loan for $10,000, how much money would you still have in your policy? I think most of you have figured this out because you've seen videos that we've done. But if you had 10 grand and you took 10 grand, but you took the 10 grand as a loan, you'd still have 10 grand in your account because you use the insurance company's money. And then what the insurance company does is they just give you part of your death benefit. That whole life policy has a death benefit associated with it. And that death benefit is guaranteed by contract to be paid out to your family or your beneficiary the day you die. And I'm sorry to bring the bad news to everybody, but none of us are getting out of here alive. We're all going to go home. We're all going to go on to a better place. Okay. At least I hope we all are. Okay. So when you go on to that better place, the death benefit is paid out to your family. The insurance company allows you to tap into the death benefit up to the amount of your cash value. So if you had 10,000 in cash value, the insurance company will allow you to use 10,000 of your death benefit. And that's what they're doing. That loan they're giving you from their general account is effectively a loan against your death benefit. So if you started with a $100,000 death benefit and you took a loan for 10,000 and you died the next day, 90,000 would be paid out. Just trying to help you all understand this. That isn't the important thing. Okay. The important thing I'm trying to explain to you is going back to when you said you had a bank that paid you 6% and that same bank would lend you at 5%. You would always borrow 5%. The same thing here. If you had 10,000 in cash value and you could take a loan from the insurance company for 10 grand at a lower interest rate than what you're actually earning, you would do that all day long. And then what happens is your 10 grand continues to earn interest and dividends uninterrupted. Now, I know I went long on that. But let's come back over here to what we were talking about with the market. What we're trying to do for retirement planning is finding a way to not have to take money from our stocks during a period of time when the markets go down. Now, we already know we've solved part of your income problem because we moved some of your IRA money, or we didn't, but you did. You moved some of your IRA money to a self-directed IRA and you found a private lending deal at 9%. Some of you will do that. Some of you are like, I know nothing about it, so you're not going to, which is why I'm telling you how to do this next thing to mitigate any risk of taking money out of the market. Here's where I see most people go wrong in retirement. They save their whole life. Okay. Put money into all these accounts, saving for a future day and giving up a lot today. They're giving up a lot of lifestyle. They're giving up a lot of vacations. They're giving up a lot of things they could do with that money today to plan for tomorrow. And I'm not saying that's bad, and I'm not saying that's good. It just is what it is. But then when they hit 59 and a half, 60, 62, 65, whatever your age is, then they want to retire. They want to start living their life. And to live their life in a retirement, typically it's more expensive than living before retirement. I know that seems weird because your advisor is probably telling you, oh, after retirement, you'll make less. You'll be able to live on less because you won't have all these things. Yes, you will. You'll still probably have a mortgage because that's usually what we see. But working with Christy, hopefully you're following her and what she teaches with velocity banking, and you're not going to have any debts. But if you do, well, let's get rid of those first. How would we do that? Right here. Remember, we had this thing that we're diverting the money that we used to put into our 401k over to this whole life policy. And as we're diverting it over to the whole life policy, we're doing that for two reasons, not just one. Actually, we could even say three. We're doing it to protect our family with a death benefit. Let's never forget that that is important. Secondarily, we're doing it to build up the cash value in the policy so we can use it for retirement. We're going to call it a volatility buffer, and I'll show you how that works. But thirdly, we're doing that today to also help with things like Christy teaches and how to pay down debt. So now I know you've probably watched Christy's videos on velocity banking. I use velocity banking. I use it at a high level, paying my house down, okay, because I don't have any other debts. But I don't have any other debts because I did this that I'm going to show you. Now, the other thing that's really interesting here is there's software that we've created. We did it in conjunction with Christy. It's called the Vault, okay? The Vault will mix velocity banking with what I'm going to show you, which is infinite banking. It is the only software that is in existence today that allows you to combine velocity banking and infinite banking to get a desired result. We call that the trifecta, okay? But that's not for today. If you want to check the Vault out, just go to well, I'll have Christy put the link up so you don't even need to know about it. But the Vault will automate this system. But let's just say you have debt like credit cards, car loans, and things of that nature. If you retired today, but you still had all the debts that you have, retirement wouldn't be easy because the income would be coming in for retirement and it would be going right back out the door to pay your debts. So the thing I always tell people is the best way to plan to become wealthier, the best way to plan for a good retirement is to build wealth today through your own debts and expenses. Now, let me show you how that works. And I'll keep this super duper simple. Here's your debts. I'm going to move this over a little. All right. And we're just going to make some of these up. Let's say you got yourself a Visa and you owe Visa $5,000. Visa is charging you 20% interest and your payment is $200 a month. You've got a car loan, okay, or a car lease, kind of the same thing, for $25,000. Your car payment is $600 a month and your interest rate is 6%. And, well, I don't know, but let's just throw student loans in there. Maybe you got student loans for yourself or for your kids, and those are only 3%. And then you're paying $1,000 a month here for those. So if we just add all this up, that's $1,600, $1,700, $1,800 a month that is leaving your family forever. But not only is it $18 a month, this is the one calculation people fail to do. How much interest are you giving up here? Well, we got 20 here, 6 here, 3 here. All right, so 20 plus 6 plus 3 divided by 3, because we had 3 debts we just did. Your average interest rate that you're giving away here is 9.66%. Let that sink in. Every month, or I should say every year, in this scenario with just the Visa, the car loan, and the student loan, and I'm just making this up, add your numbers in there, folks, you're averaging 9.66% in interest that you're giving away. That's interest you could be earning that's being given away. But not only that, you have $1,800 in cash flow going out the door to someone else's bank. This is where we need to start, folks. This is exactly what Christy teaches all the time. You can sit there and you can save, put money into investments, put money with your advisor, put money in your 401k your entire life, and you will never get to where you want to be because you have too much money leaking. You have not taken control of the money you're giving away. So remember here, we redirected the money that you were putting into the 401k for someday. We redirected that money into an account that's going to be used today. Okay. As you save money in this account, what we're going to do is we're going to take loans. I already explained all this. So we're going to take loans from the insurance company, and we're going to use those loans and the Vault software
to go in and strategically pay all the debts down. Now, in this scenario, we would pay the Visa off in most cases, the first one. So Visa was $5,000. So instead of taking a $10,000 loan, we take a $5,000 loan from the insurance company. We use that $5,000 to pay off Visa. So now you no longer owe Visa $200 a month. So what are we going to do with that $200 a month? We're going to take that $200 and we're going to put that back into the policy as a loan repayment. Because remember, we started with a $5,000 loan. The insurance company is charging us 5% on that loan, hypothetically. Rates are different with different carriers, just being transparent. So every single month, or let's just do it for the year, in 1 year, if all you did is took the $200 that you used to give to Visa that just never seemed to be paying that sucker down, well, you're not going to at 20%, you took that $200 and you redirected that back to the policy as a recapture. We call it a loan repayment, but we'll just say you're recapturing $200 that you used to give away. That $200 is $2,400 a year. So if you applied that to the $5,000, well, you're ahead of the game now. Okay, so now $2,600 is the balance on that loan after 1 year to the insurance company. The insurance company that started, and this is just like home equity lines of credit, simple interest. They're charging you 5% on $5,000, but every month you paid that $5,000 down. After 1 year, only $2,600 is due to the insurance company. Do you think 5% on $2,600 is less than 5% on $5,000? Absolutely. But you see, here's one thing that a lot of people didn't let sink in. You were used to this $200 leaving your family every single month going to Visa. Now, that $200, when it comes back into your policy as a loan repayment, that's $200 that you have to use the next day. And every month, $200 more becomes available. Plus, you're paying less in interest. Plus, your spread is widening. Because remember, before we started a simple math spread, 6 minus 5. But now it's not 6 minus 5. It might be 6 minus 4.3 or whatever the APR is, when you blend that rate. Now, again, we don't need to get into the math. Just trying to help you see this. And then what we do is we use the money you recaptured plus the money that you used to put to your 401k that you're still saving, and we just keep doing this. Eventually, we pay the car loan off. Eventually, we pay the student loan off. And eventually, it's not $200 being recaptured every single month. Okay, so let's get rid of these numbers. Now, eventually, the money being recaptured is $1,800. And that isn't new money that you had to work for. It's money that you gave away every single month. Okay, you just gave it away to your debts. Now, all that money is making its way back over here into your account, which this whole life policy, we're going to call it your private banking system. And we now no longer have any debts. Now, I did this really simple. And this on top of the velocity banking concept that Christy teaches is even faster and even more powerful because I'm just giving you the baseline. But how does this help you with your retirement? Well, it helps you because you're going to enter retirement out of debt. You're going to enter retirement with more cash flow that you control. But really, what we're going to do in retirement is we're now going to have a bucket of money, the cash value inside of your whole life policy. So now you entered retirement. Okay, all your debts are gone. All the money that used to leave your family paying your debts is now in an account that has been building up over the years. So now you're ready to retire. But just so happens that you retire in 2026. At the end of 2026, now let's just go into the future. I'm not telling you this is what's going to happen. Let's just pretend for a second and kind of just visualize this. At the end of 2026, the markets start to fall. 2027, we enter a recession. Now all of a sudden, this is real. The markets go down 20%. Then the markets go down 30%. And the markets go down 40%. You're freaking out because your 401k is now losing money. And this is what you're living on. Part of your income is coming from your 401k. Here's what we do. And have you ever walked into your house when it's nighttime and everything's pitch dark in your house? What is the first thing you reach for? The light switch, right? We all know that. You flip the light on. Now you got bright lights. I know this is silly, but this is how I want you to think about this. When we start getting to a point where the markets start going down, we literally find that light switch and we turn it on. We just flip the light switch on so that your income you were taking from your investments now starts coming from your whole life policy. That whole life policy is guaranteed to grow every year You'll have more than you did the year before. It can do nothing else because it is guaranteed. So now, when this recessionary period happens, your 401k, you just leave it alone. You just close your eyes. You don't even look at your statements anymore. Just forget about it because the markets go up and the markets go down. And you've already heard this. You got to invest for the long haul. But it never said, and Warren Buffett never said, invest for the long haul and take income from your 401k or your investments when the markets go down. No, they never said that. So what we're now going to do is we're going to take income from the whole life. And we're going to do this in either withdrawals or loans. We can pick and choose. We'll help you with that when we get to that point. And now by taking money from the whole life to live, you leave the 401k alone. So now you're not facing withdrawals or drawdown effect or any negative impact of running out of money. You're just letting the 401k and the investments do what they do. You know, they're being managed by an investment professional, hopefully a good one. Okay. If you don't have a good one, that's something else you can get a hold of us about, but that's going there. And now your income is coming out of a guaranteed source. So you've got income coming from the whole life. You've got income coming from Social Security if you decide to take it. Maybe you decided to move money into a self-directed IRA and do some private lending. You're diversified. But what you did is you put a buffer on volatility. Now, you remember before when I was telling you we're going to build bridges? This is the bridge. But you see, there's one final thing that I want to hit, Christy, before we wrap this up. So I know I covered, human emotion and how that plays into the markets. Then we talked a little bit about a way to mitigate some of that, like Chuck and Mary Jones, okay, where they basically got off of the grid, got out of the market and started becoming their own bank by doing private lending. Then we talked about how to get rid of debt a more efficient way by not using new dollars, but dollars that you're putting into your 401k that maybe you should redirect into a today account, not a someday account. And now what we're doing is we're talking about volatility buffer. So we're coming full circle. But there are also times in the volatility buffer strategy here where the markets are going up. When the markets are going up, we're going to flip the light switch for the whole life back off. The whole life is going to continue to keep growing. We're going to take income from the 401k because now the 401k is favorable because it's going up to take income. But here's something that maybe you didn't think of. You're always going to have cars. Cars get old. The mileage goes up. They break down. You're going to continually buy new cars. I don't care what age you are. I don't care what you do for a living. Almost everybody is going to need a new car in the future. So now, when that whole life is just sitting there, let's come back over here to this example of the whole life. And this is called the infinite banking concepts, IBC. We already paid off all our debts. So let's get rid of all the debts. Now all your debts are gone. You're retired. You no longer need to take money from the whole life policy anymore. But now all of a sudden you need to buy a car. Okay. How do you buy a car? You could pay cash for it, which is like, in my opinion, one of the worst ways you can buy a car. Okay. You could finance a car, pay principal and interest to the bank. Also not a good idea because now we're giving money away again. Okay. You could lease the car. Same thing. Now you're really giving money away and you got no asset. Or you could steal the car. And I doubt any of you on here definitely are not stealing cars. So we can eliminate the fourth option. But there is a better way. You could now go into your whole life policy and you could take money, a loan. Let's call it what do you think, Christy? $40,000 car? $50,000?
Yeah.
Let's do a $50,000. Let's buy a nice car. We're going to take a loan from the policy for $50 grand. We're going to come over here. We're going to buy that brand new automobile you really, really wanted. But in doing that, what you also did is you sat down at the dealership and you figured out that if you would have financed or leased that car, let's just use lease because that's the cheaper way, that car still would have cost you $1,000 a month. And I'm probably not too far off. 50 grand. Actually, that's probably spot on for a lease. Probably $1,000 a month you would have given away. So what I would do is I would still make that $1,000 payment, but I would take a loan from my private banking system the whole life. I would buy the car for 50 grand. I knew that it would have cost me $1,000, but I want to keep that $1,000 in my banking system. So I'm going to make a payment every single month from your earned income back to the policy for $1,000. Now all of a sudden, what you've done is whatever the lease factor was, which is probably 6 or 8% as of today's leases, anywhere between 4 and 8%. That's the interest rate you pay on the internals to figure out that lease payment. You're paying that back to yourself. So now the same thing is happening as I showed you with the debt. Every month, $1,000 more comes back into your policy. You're driving your new car. Everything is exactly the same, except for you're now in control of your money. And where this really helps is no money is leaking your family and funding somebody else's bank. You're 100% funding your private bank, which someday in the future will then be used over here as a volatility buffer for income when the markets go down again. Because listen, the markets will go up, the markets will go down. But we don't want to worry about when they go down. We just want to have a plan. And I just gave you a plan, but I gave you a plan for literally 3 different stages of your life. And all of you watching this can benefit from one of those different ones. So hopefully that was helpful. I know it was a lot, but it was all the same thing.
That was very good information. I think you answered every question that somebody could have about retirement. But I have a question.
Sure.
I get this question a lot. People that have term life. I've never even thought about asking you this, but I have a term life that's ended. My 20 years is up. Now they're asking me if I want to convert. Well, how do you feel about that? Converting into a whole life?
Yeah, that's usually, so I think it's a great thing. If you've got they call it a convertible term policy. So they're asking if you want to convert that into a permanent life insurance policy. Let's just call it a whole life policy. That's great. But I mean, I'll pick on you. You're in good health. So if you're in good health and you could qualify for your own standalone whole life, it usually makes sense to do it on its own without converting. But let's just say somebody had medical conditions. Something happened. They got a diagnosis that makes it so they don't qualify for a new life insurance policy. That convertible option for their term is the best thing ever because that guarantees they can convert it to a permanent policy that will never end. And just for the record, I know a lot of people love term. They love term because they think it's cheap, but do the math. Term insurance is the most expensive life insurance you'll ever buy. And Christy just said this is the reason why, is it almost is guaranteed that you will outlive the term 10, 20, 30 years. Just by statistics, you guys can Google this yourself, chat GPT this yourself. Less than 2% of every term policy sold is paid out. Less than 2%. So the insurance companies pocket 98+% of all those premiums that you paid for that term. Although those premiums were cheap, they were actually really expensive because you got no value from those premiums. You got a peace of mind that you were protected during that period of time. But if nothing happened and you outlived that period, that was a really expensive life insurance policy. If you had started with something like a whole life, you would have been guaranteed to get your money back in cash value for that whole life period policy over a period of time. The ones we design, the specially designed ones, do it much quicker. Usually 5, 6, 7 years, you get all the money back. The cumulative return of your premium is there. The term, the best thing you've got going on is what Christy just said. If it's convertible and you can convert it into a permanent policy, a whole life policy, that's always a good way to do it. Run the math. And if you can convert but you're healthy, run another calculation to show you how much it would be if you did it on your own versus converting. But I think that's a great provision on term insurance.
Yeah, I think that's good information. With me having the infinite banking whole life policies that I'm using, I just wonder, I get that question a lot. And even in my case where I have the whole life policies, I'm still considering converting that over to another permanent, even just because the premiums are pretty low every year.
100%.
Yeah.
And I don't think that's a bad idea at all.
Okay. All right. Well, that's just a lot of information. And I love when you bring, a new approach to the infinite banking concept and what that can look like in individual lives. I will say my husband worked for 32 years. He retired and he had built in the 80s. They were screaming to us in high school, you've got to get that job that pays the retirement. You've got to get that job that pays the retirement. Well, here he is retired. He retired at 50 years old. He's 55 now. And the problem with all of that money he stashed away is he can't touch it until he's 59 and a half. And when, I was telling him about the infinite banking concept and how had he been stashing the money, in those policies, he could have been using it all this time. But now, he can't touch it. And that's very aggravating. And retirement, I've got news for you, doesn't pay enough to live in this day and time. So when you were talking about the couple with the $1 million, I know that's not going to work, especially as we get older, taxes increase, and they sell that lie of, you're going to pay less taxes when you're retired than you are, right now. I don't buy that at all now that I understand how everything works. But, people, you really need to think about what's really going to happen in retirement. I'm thinking about it, and I'm 54 years old, just started later than I should have in life, but I'm kind of glad I didn't, fund all of the retirements that, the 401ks basically is what I've been offered. So, I just feel like that was good information, Chris. I appreciate you so much for taking your time to educate the people. We're uneducated when it comes to finances in the US. Totally. And I feel like that every new type of information that we can bring to people, at least it shows them options that they have. And if they choose to do it, fine. If they don't, fine. But if you don't know, you don't know, right?
I think that's it. And the one quote that I literally live by, and I think is the most true, is Will Rogers said it. He said, the biggest problem in America is not what people don't know. The biggest problem is what people think they know that just ain't so. I mean, if you let that sink in, it's not what we don't know that hurts us. It's what we think we know. The lies we've been taught that we make real, that we make, fact. And that's what gets us in trouble. And I think this whole training we just did here and everything you just said plays right into that. I mean, your husband, 30 years, retired what I would say would be early, but then realized, wow, I can't access all that money that I put away into this 401k that everybody told me was the thing I need to be doing. I can't take that money for another 9.5 years because the magic number is 59.5. And that's if they keep it there. We're not in control of that. So, you can recite the serenity prayer, but we got to start focusing on things that we can control. We got to start learning the things that we don't know so that we can understand how to get ahead in life. And what you teach on your channel with velocity banking, what we're teaching with the infinite banking concept, the combination of those two are so incredibly powerful. And I just think down to the simple thing is so many people go through their entire lives just working harder, working overtime, taking on additional risks in their life, creating more stress in their life to chase this false narrative of this thing called retirement, that then they get there and they're like, wow, what went wrong? What did I screw up on? Why didn't this work out the way they said it was going to? Why is the market not where it should be? Why is everything always stacked against me? It's the blames, right? It's not. It's just we're plugged into a system that we don't control, plugged into a system benefiting someone else. The banks, the institutions. We need to take control back, and we need to learn how to do what the wealthy have done for decades upon decades. And that's exactly what we're teaching.
Right. And, the poverty penalty is a real thing. And the wealthy have learned how to kind of get out of that. And when we're dealing with these interest rates that we are on this debt, it's just killing us financially. And we don't even feel it because we don't even realize what's happening.